Real estate investment practice problem using OneNote. Closing costs rolled into the loan. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, note that we're in the icon on the left-hand side, the Practice Problems tab down in the 4250 Closing Costs Rolled into Loan tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below, scenario this time being rolling in the closing costs into the loan balance. This being something that might be more likely to be seen in a refinance type of scenario, although you might see it in a purchase setting as well, depending on your circumstances. The setup process or the look might look a little bit different in that the way you structure it to roll the closing costs into the loan may look a little bit different if it's on a home purchase process. I'll talk about that in a bit more detail in a second. But here, we just want to see the concept, what the concept would look like, and the comparison with rolling the closing costs in or paying them up front from a loan perspective. So we got our information up top. We're going to be doing our comparison. We're going to have these $275,000 on the home. We're not going to put anything down right now because we're just focused on that loan amount, the $275,000. The years are going to be 30 years. Months then is going to be 30 times 12 or 360. The rate is going to be the 4.5. That is going to be our rate. And then we're thinking about the closing costs. Now, in prior presentations, when you're thinking about the closing costs and you're trying to compare different loan scenarios, sometimes it's easier to say, hey, look, the closing costs are going to be what they're going to be, so I'm going to kind of leave them out of the equation and make the comparisons without the closing costs so that I can then make any other comparisons that I might have involved on points and the lender credits that might be a little bit easier to do. Or you can say, okay, if the closing costs are impacted or they're different in some way, either the closing costs being larger within the two scenarios you're taking a look at, you might have a situation where there's more costs on one side, but the rate is lower or something like that. Then that's when you want to be rolling them in and comparing that in the effective rate. Or in this case, we're going to be using the closing costs in different ways, either paying them up front or paying them in terms of rolling them into the loan. So, and I'm going to put the closing costs here and add them into basically an effective rate, which is similar to an APR type of calculation, so that we could see what the rate would be if we were to roll in the closing costs. So we're going to assume the closing costs at the $11,000. You can give a rough idea of what the closing costs are in your particular area, depending on, the basic averages of that particular area. Oftentimes, estimates are given that are going to be some percentage of the loan amount, which can give you an idea of what the closing costs would be. So then if we were to roll the closing costs into, in essence, one rate, and this is a similar process as we do when we're trying to compare two things, such as performance data, if you're talking about baseball players or if you're talking about basketball players or something like that, and you're trying to measure their at-bats or the free throw percentages, then you want the percentage because they might have had different at-bats and that kind of concept. So therefore, we'd like to roll this into one number, and that's going to be the effective rate, we're going to call it here. And that would be calculated as equals the rate. Then we have the number of periods. The number of periods would be 360, comma, the payment, which needs to be negative, would be the payment calculation down below of the 1,393.38, which is calculated based on the 4.5 interest rate, comma, the present value then is going to be the loan amount, the $275, but then the twist here, we're going to subtract out the $11,000, the present value representing, in essence, the cash flow up front. You're receiving the $275,000. You're not getting it in cash, but you can imagine getting it and then paying it to the seller for the home, and then you're paying out up front the $11,000. So that's going to be the difference between the two, is the net outflow and net inflow up front, right? The $275 minus the $11,000. Taking that entire thing, which would be a monthly rate, multiplying it by 12, gives us the 4.852% effective rate. Now, and then the scenario 2, we're trying to say, what if we took these closing costs and instead of paying them up front, we included them into the loan amount increase in the amount of the loan amount. This is different than a lender credit, and you might think about doing comparisons between these two options, meaning the lender credit means that you get the credit from the lender, which you then going to pay back in the form of it taking an increased interest rate, and therefore you're going to be paying an increased rate on the original loan balance, which in this case would be the $275. The lender makes the money back, and probably more than that in interest. In this case, we're rolling the $11,000 into the loan, so now we actually have the amortization table starting with a higher loan balance. Now, again, if you're looking at a purchase process, logistically, this might look a little bit different, because if you're thinking about the purchase process and trying to say, I would like to get the $11,000 rolled into the loan, then logistically, how would that work, or why would you do that? Notice that you might want to do that, of course, to try to close the deal out, and you need the cash flow up front to get things done. One option on the closing costs is to have the seller pick up the closing costs. However, if it's a seller's market, the seller's not likely to want to pick up the closing costs, and you'll be less likely to be able to get things done if you're tight on the cash flow. And therefore, another kind of setup you might look into is to say, let's agree on the price, as though the buyer is going to be taking on the closing costs, and the price agreed on at the $275,000. And then say, okay, once we set the price right there, I'd like to make one little tweak, if that's okay with you. That being, I'm going to change the offer possibly to the $275 up by the amount of the closing costs to $286,000 in exchange for you, the seller, taking on the closing costs. So then if you were to do something like that, it would look like the home sale happened for $286,000, and then the seller kind of took on the closing costs. But what actually happened really is that you basically closed out at the $275 and then made an agreement to increase it by what you believe the closing costs will be. In this case, we're going to say $11,000 to the $286,000 in exchange for the seller to basically take on the closing costs. So really what happened is you basically would have taken on the closing costs in essence and rolled them into, in essence, the loan. So that's going to be the general scenario. That can be a little bit confusing if you do something like that to do the comparisons, because of the kind of the difference in the way the loan might be structured to what you're really kind of actually happening here. Meaning what actually happened is you got the home price at the $275 and then increased it to cover the closing costs. So that's how we'll kind of analyze it. You of course would want to take into consideration any tax implications or interest implications and whatnot on if you were to do something like that as well. But we're just going to look at it from a loan standpoint now, as if the $11,000 was rolled into the loan. So now you got the loan plus the $11,000. We didn't put a down payment in just so we can see just the loan amount. So now the loan amount is actually at the $286,000. It's still going to be a 30-year loan, 360. The rate we're going to keep at the 4.5%. And then we have these closing costs down below. The closing costs are still being paid. And again, in essence, although logistically, or although on the loan it might look like the seller's picking it up, really you still picked it up, right? The borrower or the buyer in essence picked it up. So you're still kind of paying the closing costs. You can think about it this way. You got $286,000 from the lender, and then you paid $275,000 for the purchase of the home, and you paid the $11,000 for basically the closing costs. So that would be the idea of it. So if we were to look at the effective rate, then we're going to say the rate equals the rate. The number of periods is going to be the 360, comma. The payment is going to be that 1449.12, which is higher than the 1393 due to the fact that we now have a higher or larger loan amount by the closing costs. And then comma, we got the present value, which would be the present value of the loan, which is now the $286,000. That's how much money we got, but minus the closing costs, which brings us back to the $275,000, right? So we got the money of the $286,000, but we had to pay back the $11,000 closing costs in essence. Again, logistically, or the way it's set up, it might look a little different like that, like the seller's picking it up, but really you can think of it as you're getting $286 now, but you had to pay the $11,000 out in essence closing costs. So that gives us an APR of the 4.838, which is fairly close to the 4.852 APR or effective rate. We'll call it the effective rate between these two comparisons. So then we could do our kind of analysis down below. We can look at the difference in the amortization tables. Now we have the difference in the table. This time, starting loan balances are different. We have the 275 at the starting balance, which is the loan amount. The second one has an increase in the loan amount this time, this being different than what we have seen with some of our other adjustments like the lender credit, where you don't have the change to the loan amount. We actually increased the loan amount at this point, that because we rolled in the cost to the loans, that increased the payment amount. So the exchange here would be that, we got the cash flow up front, allowing us to get things done, to get the deal done. And in exchange for that increased loan amount, which of course will increase the payment amounts, and it will result in us having to pay interest on the amount of the closing costs as they're rolled into the loan. So we can do a quick glance look at what the difference would be over the life of the loan. We could say, all right, well, that means that if I was simply to calculate the payments, which are before 1393.38 times 360, we got total payments of 501,618. If we subtract out the loan amount, 275,000, we have the interest of the 226,618 over the life over the 30 years. Over here, we've got the 1449.12 times 360. That would be 521,683. So we could see that comparison. Obviously, we would be paying more if we had the higher loan balance in scenario 2. Now, we have the similar kind of timing differences that we've seen in the past, because the second scenario, we basically got the 11,000 up front. We got 11,000 more, in essence, of the money that we basically used in order to pay off the closing costs. So when we look at our timing differences, the longer the loan is outstanding, the more likely then the bank is going to be beneficial, meaning it's beneficial to us up front. And then as the time frame goes by, then that benefit is going to be removed at some point, and we want to look for basically that break-even point at the time when that would happen. Again, the reason you would do this, though, however, something like this, would be that you'd want the cash flow in order to get things done, and therefore you'd have to weigh the pros and cons or the cost-benefit analysis of the cost of doing that, which is the higher amounts of the payments and the interest on the closing costs versus the benefits of basically getting the deal done. So we got our two amortization tables. We could see how the two would basically be amortized over the 30-year time frame, both of them resulting at 0 on down below at the very bottom. We can look for a break-even type of analysis, first starting with one that doesn't take into consideration really time value of money or like the ending loan balance, right? But get an idea of where that kind of break-even point would be. And we could say the upfront cost in one scenario is 11,000. So we have that difference of, in essence, the 11,000. So the difference in the payments then are going to be, if you roll the payments in, they're 1,449. So they're going to be higher because you had that higher loan balance, versus the payments if they're not rolled in because you basically paid them up front. That then has the 1,393. The difference between the two, about 55.74. So if we just calculate this out, the 1,449 minus the 1,393, about 56 or so. If we then take the 11,000 divided by the 55.74, we get about 179 months. And then if we take that and we divide it by 12, we get about 16. So then if you were thinking about what are you going to do within this time frame, this could possibly be more beneficial if you were to possibly sell the home or something like that, sell the property before that break point, and then after that break point, you would think that would be the point at which you'd be paying more for it after that point in time. So now note that this one's a little bit confusing the way it's set up, because in some of our different scenarios or some of our other scenarios, we were able to keep one of the two options constant. Meaning if you had the 4.5 rate here and you were able to keep the effective rate kind of the same, then we would expect the 4.5 to basically be the same rate throughout the loan. And over here, we have the 4.5 rate, and then the effective rate is going to be different. So it's possible you can structure kind of a scenario like this where the only difference is like the 11,000, which might make it a little bit easier to find that break-even point. But when you have the effective rate being different for both of them, the reason the effective rate is different than the actual rate that's going to be used to amortize the loan is because there's something else rolled in there, and that results in that timing difference with which differences in the payment. So now we got to hunt around for the point at which the internal rate of return would basically be equal. Now note that this one has pretty close effective rates between the two, even though the second option would still be having a larger payment amount. So due to the fact that you have the larger loan balance. Let's look at our IRR calculations, and we just want to basically prove these effective rates first, and then we'll take a look at that break-even point. So the IRR calculations, what we're going to do is look at the cash flow. So for the first option, we got the 264. This is where it gets a little bit confusing because the 264, where does that come from? Well, on this first option, we took the 275 that we got, that we then paid for the home, minus the 11,000, which also went out in period one because we had to pay that for the closing costs. That's going to give us our 264,000. And then the second one, we have the 275,000. Where does that come from? Well, the 275,000 was the first amount that we agreed on before we upped it in order to basically include the closing costs to 286. So we actually got 286. But really what happened is we paid for the home at the 275 of it, and then we paid the 11,000 out of it. So the 286 minus the 11 gets us back to the 275. That's where the cash flow happens up front. Then we have our payments that are going out between these two scenarios for the different payment amounts. If we calculate that all the way down to the bottom here and add up the cash flows, we've got these sum of the cash flows, which is the 237,618 minus the 246,683. We got a difference of 9,064, and then we've got the IRR, which is basically the equals IRR of this whole column, then times 12 to get the yearly rate, and that comes out to the 4.852 and the 4.838, which should be the same as our effective rates that we calculated up top right here. We got the 4.852 and the 4.838. So again, they're fairly similar, even though we have a substantial difference in the cash flow, and that's in part due to the timing differences that are involved. Remember that 11,000 being paid up front. If something's paid up front, then it's worth a lot more in time value of money than if it's spread over a 30-year time frame. So even though the total dollar amounts would be different, when you take into consider time value of money, you might have a similar internal rate of return, or basically rate. So then the next thing we could take a look at is try to say, okay, well, what if I look for that break-even point? So the break-even point, same scenario between the two, same starting points, but now we're going to stop it off at, we said the break-even point was at the 197 time frame. So 197, if we stop at 197 payments, we will also need to pick up the ending loan balance. So if I go back up here to my amortization table and say, okay, we stopped this first one out at 197, which is right there. We're going to say then we'd have to pay off the last loan amount. Cash flow out would be 169,6898. Plus, we'd have to pay this last amount, 1,393. That's where we get that last outflow of the 171,091 to close out the loan. And so we'd add that to our final outflow here. So if we summed it up, we get the 180,195, and the IRR, the rate at which this series of payments would be zero, comes out to the 4.914. Then if we did this same calculation for the second item here, for the second option, we're looking for the 197 payment again. 197 payment for the second amortization table is right there. So I would then say, okay, now we got this loan balance. We'd have to pay off 176,486 plus the 1,449. Then we'd have that outflow at the end of the 177,935 outflow. So we got the 177,935. The total comes out to the 186,963. And then if we take the IRR, the internal rate of return, which is the rate at which this series of payments would be zero, we get to the 4.898. Pretty close. Notice that these two, neither of them represent our effective rate. per se, because again we have that difference in the flow. So we got to look for basically the point at which these two rates would be the same, which would in essence be our break-even point, taking into consideration time value of money. Note that the cash flow is still somewhat different here. If I take the difference in the cash flow, we're at the 6,968. And again, that's in part due to the time value of money. If you look for just the point at which your cash flow is the same, that it might be a different kind of point, because if you have a significant difference in cash flow up front, like the 11,000 up front versus the 11,000 being spread over the life of the loan from a time value of money standpoint, we could still have a significant difference in value of the dollars. So that's why this IRR and the cash flow could be a little bit different. You could figure it out both ways if you would like, right? You could figure out where the cash flow would be as equal as possible, and you could figure out where the IRR, which typically would be thought to be more accurate because you want to take into consideration that time value of money, the 11,000 going out up front being worth a lot more than the 11,000 that's spread over the 360 periods.